On August 26, 2026, Abercrombie & Fitch released its second quarter earnings, and the market reacted with immediate force. Within hours, the stock surged nearly 29%. Investors were reacting to two specific headline figures: a record $1.3 billion in quarterly net sales and an eye-catching 19.9% operating margin. But placing those two numbers side by side reveals a mathematical tension. Expanding operating margins to nearly 20% usually requires massive volume scaling. Here, overall net sales grew by a relatively modest 5%. Looking closer at the store-level data, the tension sharpens. Overall comparable sales, the measure of revenue from existing locations open at least a year, were entirely flat at 0%. This brings us to the actual financial statements. Here is the condensed consolidated statement of operations. Midway down, reported operating income sits at $252.7 million, representing 19.9% of net sales. This single line item is the anchor for the market's aggressive revaluation. To determine if this valuation is structurally sound, we have to look past the top-line headlines and mathematically deconstruct how this margin was actually built. We start by examining the cost of sales, where a substantial one-time accounting windfall is currently sitting unrecognized by casual observers. Isolating this core operational run rate from the headline noise is the only accurate way to evaluate Abercrombie's business trajectory for the rest of 2026. The company reported 5% overall net sales growth, marking its 15th consecutive quarter of expansion. This table breaks down net sales by brand family. It explains exactly how total revenue expanded while same-store comparable sales stalled. The namesake Abercrombie brand is acting as the primary engine. It delivered 8% growth in total net sales, supported by a healthy 4% increase in comparable sales. Hollister presents a different reality. While its total net sales climbed 2%, its comparable sales actually contracted by 3%. Total revenue for Hollister is climbing strictly because the company is opening new physical stores and expanding digital channels, which successfully masks the underlying weakness in its existing store footprint. When top-line growth relies on a stark polarization between two brands, generating an aggregate operating margin of nearly 20% becomes highly improbable through daily operations alone. To find the source of that margin, we have to look directly at how the company accounted for its cost of sales this quarter. This table outlines U.S. tariff impacts. In Q2, the company received a massive pre-tax benefit of $100 million from International Emergency Economic Powers Act, or IEEPA, tariff refunds. Looking at the basis point history, this specific refund single-handedly added 790 basis points of benefit to the quarter's margins. Because accounting rules categorizes this one-time cash return as a direct reduction in the cost of sales, it mechanically deflates operating expenses and artificially inflates the reported operating margin. We can correct for this distortion mathematically. Taking the reported 19.9% margin and stripping out the 7.9% tariff refund leaves us with a 12.0% normalized margin. Stripped of accounting windfalls, the company's true underlying operating margin run rate is exactly 12.0%. To see the actual operational trend, we need to compare this 12% run rate against the same quarter from the prior year. This is the 2025 non-GAAP reconciliation schedule. Last year's reported numbers were heavily distorted, in the opposite direction, by a $38.5 million payment card litigation settlement. When you adjust for that penalty, the true operating income baseline for Q2 2025 was $168 million, which translates to a 13.9% adjusted margin. The operational reality is a year-over-year margin contraction. The core margin fell from 13.9% down to 12.0%. Extreme accounting noise, a penalty last year and a windfall this year, completely inverted the outward appearance of the company's profitability. Margins tell us about operational efficiency, but to understand how earnings per share spiked to $4.17, we have to look at cash flow utilization. The company's cash generation remains highly robust. This cash flow statement shows $313 million provided by operating activities over the first half of the year. Rather than directing all of this capital into store remodels or inventory, management is aggressively deploying it to buy back their own stock. Down in the financing activities, we see the exact scale of this expenditure. Year to date, they allocated $282 million to retire 3.2 million shares. That aggressive buying spree represents a 7% reduction in the total outstanding float since the beginning of the year. This executes a basic but powerful financial mechanic. Steadily reducing the denominator of total shares mechanically amplifies the value of the earnings numerator. When you take the normalized 12% operating margin, add the $1.75 per share tariff benefit, and pour all of it into a 7% smaller share pool, you engineer a massive surge to $4.17 in earnings per share. This massive EPS beat reflects a calculated shift toward aggressive capital allocation and float reduction, prioritizing financial engineering over traditional organic sales volume. These accounting realities and cash flow mechanics are now the foundation for the remainder of fiscal 2026. Following the Q2 results, management released this upgraded full-year outlook. The top-line target remains highly modest, projecting net sales growth of around 5%, which perfectly aligns with the flat comp retail environment. Just below that, the operating margin outlook is raised to a range of 14.5% to 15%. However, this forward margin guidance explicitly includes an estimated 220 basis points of full-year favorability from those same IEEPA tariff refunds. The normalized operational outlook is substantially lower. With modest sales growth and a lower normalized margin, the forward valuation relies heavily on the continuation of their capital return strategy. Management confirms this by upgrading their share repurchase commitment to at least $500 million for the year. By aggressively buying back stock, they secure bottom-line metrics against flat retail growth. This engineering produces the final upgraded figure, net income per diluted share projected between $13.10 and $13.60. Management is effectively insulating EPS expansion from the ground-level reality of flat same-store sales. The 2026 turnaround has evolved into a highly mechanized capital allocation engine. By prioritizing float reduction, the company dictates shareholder value, even while underlying retail operations tread water.